Hello and welcome to Tradestation's Masterclass. This is the Futures Plus version of Masterclass, and it is actually the Futures Series Spreads and Options. This is lesson 2. We're going to talk about advanced future spread trading techniques, and my name is Brandon Wendell, Chartered Market Technician. I'm a trader and a training mentor. Before we get started, just letting you know, I don't actually work for Tradestation. I'm an independent contractor, and I have been asked to come in and give you some education on this topic. But there are some disclaimers and disclosures. Again, this is for educational purposes. I'm not giving any recommendations about the markets. There's always risk in the markets. We can never eliminate the risk. And well, we'll jump into this with a little bit of my background. I've been trading for about 30 years now. And I actually started off as a broker at a retail brokerage, and I moved into back office operations. And in those back office operations, I had I was trading for the brokerage as well as filling customer orders. Sorry, making adjustments there. So I was filling customer orders as well as orders for the institutional customers as well as the brokerage. And then I ended up getting an opportunity to trade for a private hedge fund. And it was a relatively small fund. I only had 50 million AUM, but it was a lot of fun, good information, good education for me. A good experience. So I traded the markets actively, and then I was training other people. So I eventually moved into the education space. So I kind of quit the hedge fund. Now I just trade for myself only, and I teach trading and mentor traders as well. So I've been doing that for quite some time. I'm active mostly in the futures markets and in options, and a kind of a combination of the both. So we're going to talk about that today. As I mentioned, I'm a chartered market technician, which is kind of like a master's degree in technical analysis. I attained that in 2008. So I've been doing this for quite some time with a lot of experience in analysis as well as the active movements and trading of the markets. So we're going to talk a little bit more about the futures spread trading, which again is not options trading. This is actually just futures. If you need to go back and review lesson 1, please do. But some of the pros of that is that we are market neutral when we're doing spread trading. We're trading in the manner where we want to profit from changes in price between two related securities. So it doesn't matter if the market's going up, down, or sideways, there are still opportunities. We are also long and short, so we're delta neutral. We don't have as much directional risk. It's not necessarily eliminated 100%, but we can get nearly no directional risk. So lower risk means lower margins and better drawdown management possibly. So the other problem is, though, if you have less risk, you always have less reward. You can't have one without the other. So if you want to have more reward, you got to have more risk. And because the risk is lower in spread trading than it is directionally, we have lower margin requirements. The cons, because there are always cons, and obviously we expect things to happen in a certain way on a regular basis, they don't always happen. So we could get correlation failures, patterns might break down. We're trading more than one security. So instead of just trading a long or short on a futures contract, you're doing both at the same time, and you have to pay 2 commissions because it's 2 securities. Well, there's also some issues with liquidity. We want to make sure we're trading liquid securities. We're not always trading the front month, and that's the problem. Front month securities have the most volume, but there are back month securities that are tradable, and we want to make sure we get the best spreads, meaning bid-ask spread, when we're trading our spreads. So sometimes there's some issues with liquidity and we have to get worse pricing. We also have to be very careful whenever we use leverage. Leverage can be very dangerous. It's nice because it increases the amount that we may be able to purchase of a security, therefore participate greater in that move, but it also increases the risks. Can't have one without the other. So I mentioned about the 2 types of spread trading. We have intra-market and inter-market. And in the intra-market, we actually have some kind of I guess you could say, subcategory. We have bull spreads, which are basically where you're buying the front month and selling the back month at the same time. Okay, so basically with that, we're doing that to profit from an upward move in the underlying security. If the underlying security is moving up, the front month typically has higher volume and will move further and faster in that direction, while the back month doesn't move as fast. If the markets are moving down, because you're also short on the back month, you can actually have a little bit of downside protection in that move. So we have lower risk and lower margins and lower rewards. Now, obviously, we lose money if the back month rallies more than the front month. That can happen. It's not as likely, but doesn't mean it can't happen. And the profits are obviously going to be smaller than if we do directional trading. The reward is obviously if the front month does move up further and faster than the back, there is that opportunity to make profits. And the rate of return can also be relatively high in comparison because often the margin is very, very low, as I mentioned. So the rate of return gets increased because of that. So moving on here, if we were seeing that there's a move in live cattle, for instance, and we expect this market to move to the upside. This was December 2024 contract on a 4-hour chart. We were expecting that price to move to the upside. On the individual contract, you can either buy the contract itself, which you would use a margin of about $2,695, or you could actually buy that contract, the LCZ24, which is the December contract. At the same time, you would sell the back contract, which in this case would have been LCJ, the April 2025 contract. The margin is reduced less than half. It's only $1,210. And you're still participating in an upward move in the price of the underlying security. As I said, if the markets move down, you have a limited amount of downside protection as well because they may both move at the same pace. The spread would not lose money. But if the front month were to move down faster than the back month, then you would actually lose in the spread. But it typically is at a slower rate of loss than you would if you just had bought the front month by itself. So another example here, if we're expecting corn to rally in price, you could buy the front month. And again, we went from a little support level here up to a little resistance level or demand supply. And there was a margin of $1,100 to participate in that move up. Or you could have done a spread where you bought the front month and sold the back month. And the front month did move up further and faster than the back month, widening the spread. And the margin was only $275. So again, you're able to take these overnight positions with a lot less margin, which increases your leverage and your buying power, but also risk. Now, the trading dates, the profits, and the risks of the different strategies are going to be a little bit different, of course. But main thing we look at is that there's decent rates of returns with limited capital participation when it comes to the spreads. So a bear spread would be doing the opposite, where you're going to sell the front month while buying the back month. And the reason why we expect the front month to move down further and faster because it has more volume, it's more actively traded, and we do this with lower margins than if we had done just the single contract. Obviously, this can lose money if the back month fails to fall faster, the back month falls faster than the front. And the profits are definitely smaller than if you just went ahead and shorted a contract or sold a contract. The rewards, obviously, is if the front month does drop faster than the back month, the spread widens, you profit. Because you short the front month, you buy the back month. If they both go down, your one position makes a lot more than the other loses, and your net positive. So the rate of return can be high due to lower margin requirements. So same thing here. You can see that using a front month, this is intra-market spread trading. One way we can do this is we could just simply enter the spread if you see that the front month contract is hitting a demand or support level and getting ready to rally. So you pretty much put on the spread as a substitute or a surrogate for putting in or just buying the front month contract. That's one way of doing this if you want to. Or if the price is up at a supply zone, you can see right here, we came up to a supply zone where prices is sold off. This is on the single contract itself. And instead of just selling that front month contract by itself, you can put on a bear spread where you sell the front month and buy the back month. The margin drops, the profit drops as well, but the rate of return might still be pretty high. Now you'll notice if you look closely, we went pretty deep into the supply zone. We never actually touched it on the spread chart. Okay, so the charts will be slightly different. And the trigger was we entered based on what was going on with the underlying security, the front month chart. So it may not be the best timing, but it's one way of doing this. You look to see, okay, I'm looking to go long on the NASDAQ. Well, I could just buy the NASDAQ futures, or I could buy the front month NASDAQ, which right now would be March 2025 as I'm recording this, and then sell the June 2025. My margin requirement drops dramatically from about $26,000 to about $300. And of course, my rate of return It still could be pretty good, but it's not going to be nearly as much money that I would earn as if I just bought the futures. So another way of doing this, which is a little more accurate, is to actually utilize technical analysis on the spread chart. So here I actually charted the intra-market spread. This happens to be on Lean Hog's December 2024 versus February 2025. And I simply sell when we reach areas of supply, and I get out and buy when we get down to levels of demand. Or again, I use supply and demand slightly different than support and resistance. I don't want to get into that right now, but there are other workshops that I've done that you can look up and see information there. Anyway, but yeah, we just use the same type of techniques. Another popular one would be to use Bollinger Bands. On this intra-market gold spread, this was December 2024 versus April 2025. This spread, we went with a line chart to see it a little bit better because there's a lot of wicks sometimes on intra-market. So this is a line on close, and once we get a close above the band, back inside the band, there might trigger an opportunity. Or in this case, even better, we were at a prior supply selling area where we had that imbalance. And if you sold there, not only were you selling at that origin of previous selling pressure that picks up again, but you also had the close outside the band, followed by the close back in, and preceding that dip in price down to the bottom band. So that's pretty cool. But you can chart the underlying security itself. One other way of doing this, so we have three. One was to just use as a substitute or surrogate for the initial front month contract. When the front month contract goes at demand you want to buy, you do the spread instead, the bull spread. If it's at supply, you do the bear spread instead. Or you can chart the individual security that you're trading, which is the spread, and take your technical cues off that, the actual spread chart. Third way is what's called seasonality. Basically, every security has a season to it. You have a spring, which is the start of a bull market, summer, the full-on bull market, autumn, where things are turning, and then you have winter, the full-on bear market. Now, it doesn't correlate to the calendar necessarily. The spring may be March, but it may be September. Okay? It just depends on the security itself. But these patterns repeat over and over and over again. You can see that I don't remember what this one was in particular. If it was, maybe this was the nat gas spread here, but it was a longer term spread that was 172 days long for the pattern, and it won 100% of the time for the last 20 years. So there are certain patterns out there that give pretty good opportunities. The risk reward ratio, about 17.24 as well. Now, the problem is with seasonal data, sometimes you have to pay for it in order to get it, and the patterns don't always repeat. You also might suffer some drawdowns with those patterns, so you got to be careful of the drawdowns or use your technical analysis with the seasonal moves to give you an idea of when to actually time your entry. And you can place stop losses as well. You can look and see, yeah, this one didn't have too bad of drawdowns on average. The average profit was decent, although in the last 15 years, you can see the average drawdown was almost half of the average profit. So that could be a little bit risky to try to take something like that. But you can always place stops at 1/3 of what the expected potential profit is going to be and adhere to certain rules and build your rules based on that. So nearly every security has a seasonal move to it. As I said before, spring is that slightly bullish trend. Summer is where the full-on bull trend is going. You got the end of the bull trend, the start of the turn to the downside for autumn. And then you have the full-blown bear market, which is winter, as things are moving down. So mostly commodities are seasonal, but other things can be too. And the way you decide these things are seasonal is look at patterns over a long period of time. Well, you don't necessarily need to do this because it's been done for you. There's several different services out there that you can pay a subscription fee to and actually get the seasonal data. You may have heard some of the sayings for the tech market, NASDAQ, sell in May and go away. That's a seasonal reference. So you're basically referring to the seasonality of the stock market, that things usually turn to the downside towards the summer. Or the Santa Claus rally, if you heard of that. In November, December, January are usually very bullish times for the stock market. That's a seasonal play as well. So most securities have some sort of seasonality to them. Commodities definitely do. Anything that's grown or pulled out of the ground usually does. Now we have the other type of trading, which is intra-market spread trading, not that's intermarket. I didn't get there yet. Sorry. Exiting. I forgot. I got ahead of myself here. So exiting intra-market spreads, basically you take profit or loss based on the underlying securities chart, the front month chart again. So if you wanted to, we got in based on the front month doing something like hitting the upper band or lower band or hitting a support level or resistance level. You do the same thing. When that front month security hits your targets on the chart, you just get out of the spread, win or lose, whether it's your stop loss or your target. With seasonals, you can do the same thing. You can see there's usually, when you subscribe to seasonal information, it'll tell you enter approximately this date, exit approximately on this date. Well, it could be on that day. You could get in anytime you want. When the seasonal window's closing, you decide. It could be at the end of the day. It could be sometime during the trading day, whatever works best for you, or a particular profit amount. If you get what was expected, perhaps you just take your profits and walk away. You should definitely have some sort of stop loss identified, maximum risk that you're willing to take, and adhere to that. Make sure you get out. So one of the things that it's talked about quite a bit when it comes to seasonality and with the securities, we got to make sure we're trading things that are relatively related to each other. So there's what's called co-integration, and it may not be the best example, but they use it. It's called a drunk and his dog. So with co-integration, basically we have correlation, which measures how two securities move in relationship to each other. The relationship, like the NASDAQ and the Dow, they're both equity indexes. And well, maybe the NASDAQ and the ES, the S&P futures, that's probably better because they have a lot of overlapping components. So they're very highly correlated. They will move together. You also have silver and gold. They're both precious metals. They have commercial properties as well, or applications. So they are very correlated. Now, co-integration is going to be a little bit different. Now, correlation, if contract A moves up, contract B usually moves up. Contract A moves down, contract B usually moves down. But if contract A moves up and B goes down, that's what we call negative correlation. They move opposite of each other. That would be the NASDAQ versus the bonds, 10-year bonds. Typically, they try to move opposite of each other because one is risk on, trading the stock market. The other is risk off, trading the bonds. So basically, correlation measures how two variables move in relationship to each other in tandem. So co-integration is basically what we're trading. It's the spread. And what happens is it doesn't widen indefinitely. It doesn't go apart forever. It usually reverts to a mean. Price in general, the markets in general, are very mean reverting. They go back to the average on often. That's why people use moving averages on charts. You move away from the average, snap back, move away, snap back, while the average is moving. Well, the same thing happens with the futures and related securities. We can trade the spreads when they go away or together, meaning widening or narrowing. We talked about that in the first lesson. So basically, the co-integration, it measures what the difference is between them and whether or not it remains constant. So like a drunk and his dog, they're attached by the leash. So that distance is going to be constant, but the dog and its owner are not always going to be walking at the same distance from each other, right? Sometimes that leash is going to get closer, sometimes further apart. Maybe they're using one of those retractable leashes and get much, much longer or shorter. So basically, if you have two people that don't know each other and walking down the street, they're both drunk and they're walking on opposite sides of the street, they don't know each other at all, they have no relationship to each other. And their movement will have no relationship to each other at all. Okay? I'm trying to fix something here, but I guess I can't. Okay. So again, if you have two people don't know each other, they're just walking down the street, they can go whichever direction. One can turn right and the other can go straight or left. It doesn't matter. But if the drunk and their dog are walking, they have some independence. The dog can walk around a little bit left and right. They could slow down, they could speed up, but they can't go beyond the length of the leash. There is a relationship. And that's important when it comes to trading futures. We have to have that co-integration between the two securities. You can't just trade one security versus another because you like it. They have to have a co-integration, a relationship that they usually will either stray away from and then revert back to, or come too close and revert back. If the dog steps right in front of the owner's feet, the owner might trip and the dog runs to the end of the leash. So that's what we're trading when it comes to spreads. Now, we do this more with intermarket spread trading. We need to find two co-integrated securities. They're related. They might be correlated as well, but they're definitely co-integrated, very related. And we're trading the spread. So the way we do this is with technical analysis on the spread chart itself. That's the best way to do it. Really, I guess that's pretty much it. You can look for price to violate Bollinger Bands. If you get closes outside the bands, followed by closes back inside the bands, you can see I had a short entry here, and then we got the short exit. Same thing, we close outside the band, close back in, triggering a bounce in price. So you can use trading tools and systems like you would on directional trading, just apply to a futures spread chart instead. Or supply and demand, support resistance, whatever you want to use. Again, in this case, I've identified an area of supply where there was a huge imbalance, lots of selling pressure, very little buying pressure here. So when prices returned to that area, we basically saw that it was likely to drop. It took a little while, but prices dropped. So if you sold the spread, profited when it moved down. That's it. Keep it simple. Chart the spread, trade the chart. And there is seasonal spread trading as well. So in this one, we have, gasoline. That was actually an intra-market because it's gasoline, but there are also intermarket spreads available as well. And you can place your stop loss based on 1/3 of the potential profit that you're expecting for that seasonal move. Or you can identify a potential date that you wish to exit as well. But again, the one drawback of getting seasonal data is that you got to pay for it. And, it's not the most expensive thing if it's worthwhile to you, but if you want to, you can just go out. I'm on Tradestation, Futures Plus here, and I actually have intermarket. Let's see here. I have corn versus soy meal, notional value. And I'm on a 4-hour time frame right now, and you can see that if I'm looking to trade this, there may be an opportunity coming up. Matter of fact, what I'm noticing right now is that, let me widen this a little more. And I can draw on these charts here as well, but I happen to have, let's see, where's Ray? We happen to have an area of imbalance right here that we're coming into, or have come into. I'll widen this a little bit more. There we go. So we have an area of possible demand, and if I expect the price to bounce up to an area of supply, now I'm not saying this is an excellent trade or anything like that. I'm just identifying a possible supply and demand right now. And there's more analysis I would do before I took this type of trade. Let's see, looks like this is the bottom of that zone. There we are. So looking at this, and actually, let's see, font size will go a little bit bigger here. Much better. I can now see, because I'm in notional value, if you remember what notional value is, we talked about that in the first video. It's basically the actual values here. So we have 26,687, 26,800. So we're looking at about, what, $113 difference between those two. So the risk is roughly, let's say it's $120. Go be a little bit below for the stop loss if I buy here, and if I buy as it leaves the zone. And I can also determine my target. Well, we're getting out possibly near 25,800, getting in around 26,600, obviously 687. So now we're looking at a move of about $800 for a risk of $125. And that's how trading can work on this spread. I would be looking at trading the spread, which is corn versus soy. I'd be buying corn. That's the first contract, and I expect the prices to continue to go up from here. And I would sell soy at the same time. So we can actually chart this a little differently as well. If I go back to corn versus soy, there we go. I can go to open market. Nope, I want chart with legs in tabs. Show you what happens here. I bring up that chart. It's on a 1 minute, so again, I'm going to change to 4-hour. Look at a little bit bigger picture. It's the same chart, except Notice if I click on the tabs here, I have March 2025, which again, I need to change to 4 hour. I might as well do it on this one too. And I have soybeans, which I can also change to the 4 hour. So I can chart the individual securities where I am looking right now at a long buying corn, selling soy on the spread chart. If we look individually, corn on the 4 hour, they actually don't look so bullish. It's a little bit breaking out a little bit right now on corn. Soybean, it's a little weak, much weaker than corn, which is fine. These can both go down, but if soybean goes down faster than corn does, the spread widens and I profit because I'm looking at buying corn and selling soy. That's what the spread is all about. And there I was able to chart the spread and the individual pieces just to get an overall view if I choose to. So seasonal spread trading, there are seasonal spreads on a lot of these different commodity spreads. And you can use that data to find better opportunities out there, but then use technical analysis to kind of narrow down the entry and exit and get better entries and exits for yourself, better pricing. So there are seasonal patterns. They're available on intra-market and intra-market. This happens to be Kiwi versus the Loonie currency spread. Looking at them moving against each other there. And in this case, what we also did was on the conversion, you can see it converted. This is actually not the same chart, but this is also an inter-market. Crude oil, December 2024 versus heating oil, 2024 December. And the conversion is the point value. So we use notional values when we chart these and look at the patterns. Remember to do that when it comes to the intermarket spreads. You'll notice I did that on corn and soy, even though they do have the same point values. It just makes it easier sometimes to see the profits and losses on the charts. So spread trading with futures plus is actually relatively simple. As I was saying, I showed you a little bit already, but there's a couple different ways of looking at the price action on the charts and also in the platform on Tradestation Futures Plus. So one of the tools you'll see is this is the spread matrix. That is for intra-market spread. So let's go out to the platform and dive around there, take a look around a little bit. I already did one where I brought up the spread, but let me show you how I got to that point. I talked a little bit about the auto spreader before. There are several different widgets that you can use to be able to trade, and one of them that I opened up was right here under automation, auto spreader. And that's what I have open right here. The auto spreader allows me to build the spreads that would be on intermarket spreads, although you can also do intra-market. So basically, if I want to create a new chart and be able to trade or watch it, I first may want to go ahead and create it here. So let's say I want to do, let's do bonds. We can do what's called the knob trade, notes over bonds. And that is going to be the ZN, the 10-year treasury. And currently I'm going to look for the March 2025. And then we have the ZB, 30-year treasury. Again, knob, notes over bonds. So notes and bonds. And currently this is in 1-to-1 ratio, which is fine. And multiplier, if I want to do notional value, that's where I would put it. Right now it's just 1-to-1. So I'll just put this as knob market, because that is the market price, and I'll apply that. I'm not going to share it. Just keep it locally here on my computer. And then I'm going to do a second one, and I'll call it knob notional. And I'll actually use the $1,000 per point multiplier right there. And you can see the tick information underneath it if you want. I'll apply that and make sure I took them both. Knob notional. Now take my first one. Let me make sure. Knob market. And that was with the 1 point without the notional value. Very simple to make the change. Save. Yep, there it is. So now I close out And you can see it's in my list here. So if I want to watch it, let me close out that chart. Got too many things open. If I want to watch it right here, let's say knob market, I can go ahead and click on it and open up a chart, or I can open up a market grid with the legs. And what it shows me is this little watch list type thing, this market grid, where I have the actual notes over bonds. It's using the front month contracts, the March contracts right now. But I also have the individual legs. Let me zoom in more so you can actually see this better. There we go. And I have a watch list that I can create if I want to. I can look a little bit at the market depth as well, bid and ask quantity. I believe you can change some of these columns as well. I'm not going to go into that at this moment, but you can. And if I decide I want to start trading, I can go ahead and, right here, and create a price alert for when I wanted to get to a certain area. That way I know when I'm ready to put in my entry order for my trade. So I can wait for that. I can also zoom back out here. Open options chains if you want for options, but we're not going to do that right now. That's another lesson we'll be doing. But here I can open up charts. I can open up an order ticket for the spread. I can open up the ND trader for the spread as well. That's my matrix where in this I can actually place my orders. Good till cancel. And when I'm ready to trade, I can simply click and confirm my buy or sell of the spread. I can also do more advanced orders, I believe, with the order ticket if I open that one as well. Now, I'm not going to go too much in depth here because it's more about what we're trading, how to actually manipulate this platform. There are classes on that in the Getting Started, I believe, with Tradestation that Jesus Nava has created for you guys. But there are different ways of manipulating the orders, obviously, and going through all this. But keeping it simple, again, looking at spreads and trading spreads, we're simply trying to trade the relationship changing between two correlated securities. So again, if I go back to knob notional, where did I put that one? Oh, you know what? I overrode it because I created, oh, that's fine. We'll create a new one here. And again, I'll do ZN, March, ZB, March. I wanted notional value, so I'm putting in the full point value, 1,000. And NOB notional, apply. And there we have it. So if I go to the charts, you'll see the difference in a moment. If I open the chart, this is the chart for the market. It says NOB market. I can also go in on my chart and create a new tab as well. If I don't want to keep creating new tabs or new windows like this, then close this one out. There we go. And if I go to my tab to open up a new, I can search for instruments, and under auto spreader, it should have, there it is, NOB market. Look at that. It has my trades already there for me, or ideas already there for me. So I create the chart for NOB market, and there it is. I happen to be on a 4-hour candle chart, which is what I had set up. But remember, this is showing the market price of the bonds versus each other. So now if I want to do the other one, the notional value, again, I can create the chart either by using the tab and bringing it up, or I can also go here to my auto spreader and bring up the open chart with legs in tabs. And that way I'm going to have 3 charts open on the same box. I can also do this individually as well. But this is, I want to do this for a moment just to show you the difference in price. That's the notional value. That's the numerical or market value, which is multiplied by 1,000 right now. And I can see the individual notes and the bonds as well for those charts. Now, how would I trade this? Again, let's say I go back to my market value chart, which I could trade any one of those. This is an intermarket spread. They're 2 related securities. One is the 10-year note, the other is the 30-year. And I can apply my technical analysis to it. I can add things such as Bollinger Bands, as I mentioned. There we go. I have RSI at the bottom, which I actually use as more of a momentum indicator, and you can change things around, the thickness of the lines, the deviations, the colors, all that good stuff. I'm just going to keep the default at this moment. And I can use the wheel on my mouse to zoom in or zoom out as well. Perhaps we want to go down to, not that. Let's go down to an hourly time frame. And again, just experimenting with this, but as I said before, if I'm looking at the individual front month securities on an intra-market, I can get my entries based on support and resistance or supply and demand on that front month contract and just use the spread as a substitute, or this intra-market spread, I can simply use either seasonal spreads and trade off that, or use my chart. And well, we had a great trade already gone through. This is in the past, but at the time, again, sorry, let me make that cleaner for us. Right here, I see that there was an area an array right here. And I'm going to change the color, that bright cyan. So right in here, we had a little drop-based rally area of buying pressure that, had you noticed this in time, would have possibly set up for a nice buy opportunity on this spread, buying the 10-year, selling the 30-year. So right here, you see prices stopped going down. We had that imbalance with lots of buyers and not much selling pressure. Prices eventually came down. Just missed it, apparently. It went right here on that wick and then rallied. So I might have missed that one, but that's kind of what I look for. Again, I apply technical analysis tools. You can use MACD, RSI, all sorts of different things, whatever it is that you like for your technical analysis to identify the spread opportunities. And as I said before, there's really only two types of spreads. We have this, the intermarket, and we also have the intramarket, which again, we can actually look at with, let's see, where is the spread? Find it now. Spread matrix. There we are. The widgets under market views. And I can search for exchange listed CME spread. And let's do crude oil. Let's see if I can go to C. CL, there we are. Select. And it's just loading right now. Oh no, I had that. There we go. Go add tab. And it should, there it is. This is the intra-market spread for crude oil. You see, I have February, March, April. So if I go across here, February versus March, February versus April, February versus May, and so on. And again, I can click on these to open up a trade simply by choosing. And right here, I can also choose what type of entry I want, where I can put in my market or limit orders, or excuse me, I can actually do a bracket order where I put in my trailing stop or stop loss and my target at the same time. Again, read the information in the quick start videos for more information on that and how to use it on Tradestation Futures Plus. But looking at the intramarket spread, I should also be able to, if I right click, open the chart as well the same way. Or if I want to keep, again, the same chart and just have different tabs, all I have to do is go to the bottom, click the plus, search for instruments, or just simply do this, CME, futures, CL, and I can choose the calendar spread that I'm looking for. Let's say I want to do February versus March. I could also create my own as well if they're not shown here, but right now I have February versus March. Select and bring up the chart. I am on a 60-minute chart right now still, and this is the intra-market spread for crude oil. This is the February versus March, which we saw right here, and also can now visually see on the chart. How would I trade this? Well, again, I could trade this in three different ways. I could trade this based on the chart in front of you. Again, we see an area of selling pressure right here. If I were to draw this out, I have a possible supply zone of selling pressure. There we go. Bring that line up a little bit. And draw the top. So I can sell if prices return to this area. Excuse me, it looks like it came pretty close to it already. Might have actually tagged it just barely. And then exit once I hit some sort of demand zone. If I look back and find where's the strong rally point, probably down here, that could be my target. And then I could calculate my entry, stop and target, and simply trade right from the chart too, as a matter of fact. There is a tool right here, chart trading, or I can create the tool, the ticket again, February, March, simply click and either do buy or sell based on where I want to buy or sell, and I can place the bracket order as I want as well. Now, the other way of trading this would be, as I said before, chart the underlying front month, the February contract, and I can create a chart that way too. I simply go here, search for securities, CME, future, and just chart the front month contract only, CL, February, select. And now I have a new chart. And I'll get rid of the Bollinger Bands for right now. But again, if I see that the front month contract is coming into like a selling area or a buying area, well, this one's not fresh, it was already reaction. This would have been a trade already based on this supply and retest. But instead of taking the trade here, which would have been at 9 a.m. on the 19th, I could have entered the spread trade 9 a.m. the 19th right there. And that's the trade that we already saw. So you can either chart the spread and trade based on technical analysis of the spread, or you could use this as a surrogate and trade the spread rather than trading the front month, but you enter and exit based on the technical analysis on the front month. The third way would be seasonally. You can use the seasonal entries and exits that you subscribe to and get that information there. So, going back, that's a little bit more information on how to trade futures spreads with Tradestation Futures Plus. Again, if you have more information about how to use the platform itself, you can contact education at tradestation.com and email them your questions, as well as there's information online. Again, at the quick start, if you go to tradestation.com and under the Learn tab, you'll find that information there. And of course, we have this video and the previous video that'll help you with understanding more about future spreads. I want to thank you for taking the time to join me with this masterclass. Again, this is for educational purposes. I wasn't actually giving any recommendations of any of those securities, and I'm not saying you should go out and trade those. It was just for a demonstration purpose. And that has been lesson 2, advanced future spread trading techniques. Look forward to seeing you guys again in the lesson 3 and beyond. So until then, trade safe, trade well. Take care, everyone.